Thank you for taking a few minutes to watch this video, and we're going to walk through the 930 trading strategy. And the link above or below takes you to the original video where it goes over all the details of the trading strategy. But I will cover some basics right here. The 930 is a trend following strategy. We use the 9 EMA and the 30 WMA, which is the weighted moving average. We use crossovers to determine the trend direction. As you can see here, uptrend, downtrend. Only looking for shorts, only looking for longs. We have two types of entries. One is a conservative entry. The conservative entry would require the full candlestick to close between the 9 and the 30. Down here would be fine as well, considering an uptrend. What we don't get is a poke above for longs. The aggressive entry just requires a close between the 9 and the 30. As you can see on this candlestick right here, it's still above the 9. Our entries for longs are buy stop above the highs, and we're looking for shorts, sell stops below the lows. We can also stair step our entry down until it gets triggered in. But once we get a change in trend direction, as determined by our moving averages, we would cancel that order. Okay, that's just the basics. And I picked an area that is not the best. It's very easy to cherry pick and show you all the best simple trades that just rocket to profit. Walking through this chart here, we do get our cross right here. So now we're only looking to go long. Price pulls back. We don't get a close in our zone. Keep watching price. Here's where we get our first close. Buy stop the high. We're in this trade, and it's a painful trade to sit through as price just ranges. We can use moving averages to determine the volatility of the market. And as you can see, the 9 and the 30 getting close together. Obvious trading range forming. We also get this happening. What I want to talk about here is we hear too often that moving averages act as support and resistance as if they're magical lines in the chart, and they don't. What you're seeing here, and this is one of the reasons why I picked this example, is these are moving averages are calculated by the closing price of the last 9 days and 30 days, and there's different weighting to the price. But what's happening is you can see the closes aren't too far away. The average closes are pretty close. So the moving averages will catch up to price. It's not that price is retracing down to the moving average. The moving average is moving up to price. That's a huge distinction. That is why you'd also want to consider that you're looking at some sort of price structure when you trade. Look left is always that familiar refrain. When you get these kind of markets here, you can see this. You can just block off obvious levels. So keep that in mind when you're trading any trading strategy. There's nothing magic about a moving average. And eventually this price does go up pretty high. Profit targets and stops. I use ATRs for my stops. You can use ATRs as well. 1.5 ATRs for stops. 2, 3, 4 ATRs for your profit targets. Or simply just use the lows. However, these spike downs, they're meant to take traders out, right? Searching for order flows down in through here. So don't just put your stops right in the lows of these. Give yourself a bit of a buffer. I want to talk about longer term trend direction. We do get a pullback here after we get a moving average cross to the downside. This is still a legitimate trade. If we go back over this trade right here, this would be the aggressive entry. And then we get a conservative entry where we sell the low of this candlestick. And we do get a bit of traction in our favor. And then we range again. But for some traders, that's going to cause a host of problems, especially when the market's whipsaw. Looking at a longer term trend direction, this is the 90 WMA, which is 3 times higher than the 30. You can see that we would not be interested here in taking short trades whatsoever. We still want our long trades. So consider using that. You can also consider normal price. And what I mean by that is swing high, low, lower swing high. We need a lower swing low, which we don't get. What is that? Well, that's a downtrend, right? Swing high, low. This, there's our lower swing low, lower than this one. We put in a lower swing high. Trades are on the go for the downside here, okay? So you can also look at price structure as well. And that would probably be my favorite way to look at things. As you see, this is stair-stepping higher. Consider that we are still in a range, all right? Don't ignore these. So even though we're looking at a 60-minute chart, in a 60-minute chart, we're still in this tight range. On a lower time frame, you would see this as more of a trending structure. And it'll look better than this one, it certainly does. So you can decide to yourself, and this something has to come in your testing and what you're comfortable with. There is no one size fits all. Are you going to consider trading any longs while this hasn't broken? Your higher probability trades are going to wait until this high is broken and we start getting some moves to the upside. And you can see over here we've broke down. Our moving averages got tighter, which meant price is not moving like it did before. We got a trend change, and prices moved down to this area that's acted as support once, twice, 3 times. Consider this 4 times, really. When it's coming down here, this is acting as support now, but don't always think it's going to hold. I use the term potential support, potential resistance, because we never know when it's going to break. When you do get into market action like this, this is where you might want to bring up a range trading type of strategy, and above and below you'll see videos that will walk through a range trading strategy for you. So here's a chart of Bitcoin. I know a lot of you trade that. This is recent market action. We get a cross of the moving averages. We get a pullback. This would be considered your aggressive trade entry. Always be aware of what you're trading up against. Okay, sell stop the low, get a little bit of traction, price pulls back. This is the aggressive entry. This right here is the conservative trade entry. Sell the low, see it chops around for a little bit, and then price collapses to the downside. Same thing that's going on in here. Get across the upside, and now we're just waiting for a pullback here. You could also consider using the Keltner channel. And why would I use this? This is a 10-period Keltner channel, and the original Keltner channel was a 10-period. And I'm using a 0.8 multiplier. You can use a 1 multiplier. What this does is it ensures that you are trading not too far away from an average price. Markets, when they trend and when they move, when they get stretched too far, they're going to come back. This is going to help prevent you, not always, it's not 100%, from taking trades and entering trades that have already moved too far. Let's look at an example and see if we can find one on here. So, go back to our short trades. Right here, cross down. We're all fine through here. We're in our downtrend. Got a price pullback. The Keltner channel we haven't had to use yet. This one here, price pulls back into our zone of opportunity. We sell the short. We're very close to 1 ATR away from the average price of the last 10 candlesticks. And you can see what happens here is price doesn't get too far away before snapping back. Price pulls back again, and you're going to have to decide how many pullbacks you're going to take, especially in these lower time frames, because there can be a whole lot of them. Price pulls back. This is all taking place inside of the Keltner channel. But as you can see, we're pretty close to the exits here, right, of the Keltner channel. This is just going to help you be a little bit more selective in some of your trades. Let's move over here where we're getting some more trending action. We got a crossover. Price moves up. These trades would take place inside of the Keltner, and so you get a nice move up. Pull back. There's no trade here because we don't have an aggressive or a conservative trade setup. We do here. We've got a pullback. If you try to take this pullback, you're right here, right up against the ATR. You can set this to whatever you want. 20 period and 1. You do the 10 and 1, 10 and 1.5. Go do your own testing for that. We also want to consider just pure price action. If you look at this in this area right here, these are strong moves against you. When we talk about trading pullbacks. So we got price moving up. What we don't want to see is this. Strong moves against you. With a pullback, we want to see just some lazy price action. Nothing too extreme. Because when we see that, that puts us on alert that perhaps things in the market have changed. These are big candles to consider trading pullbacks with. Stops and targets, ATRs. I use ATRs for all of my trading. And if you're going to just use swing levels, just ensure that if you do take a trade that you don't just put it right up against here. Give yourself a bit of a buffer. You can even use the ATR channel if you'd like. For example, if you shorted here, I'm not saying you did. If you shorted here, you're up here somewhere on the ATR channel. Just something that is not going to keep you in the noise of the market, but you're not going to be so far away that you're not going to be able to take the trade with some markets, or your position sizing is so small that it's not even worth the risk on the trade. So that's pretty much the 930. It's not complicated. Just make sure you put your rules together. If you have any questions, I'd love to answer them. Put them in the comments below, and let me know if this helped you out. Thanks for watching.